To Random Walk Conversations with smart people on various parts of the capital markets. Today, the smart person is my friend Lance Lambert, who founded the publication called Resi Club Analytics, which is mostly focused on um, mostly residential. Yeah, it's almost entirely residential real estate at the institutional level. It's a great thing. You should check it out. Lance is a super smart guy. He's been in the industry for a long time. We will, I don't know, just generally iterate around sort of the current state of things. There's also a lot of data there, which I love. I guess, Lance, you want to give a really quick, like, I don't know, a 10-second version of where your background and sort of what Resi Club is doing?
Yeah. Thank you for having me. Really excited, and I love your newsletter, Random Walk.
Thank you.
I love the versatility and how you kind of move from one subject to another with really smart smart takes and just very digestible. And it's a great read. Always excited to get it in my inbox. And so my name is Lance Lambert. I'm the founder and editor in chief of Resi Club. We're a niche publication that covers the U.S. housing market, so a news and research outlet. We're very data driven, do a lot of visuals, a lot of research. We cover what's happening in the for sale market. So at any given time, what is kind of like the buyer seller dynamics around the country, how that is shifting and trending, kind of connecting a lot of the dots. A lot of our audience is home builders, land developers, people in the industry, agents, loan officers, a lot of single family landlords, groups that deploy institutional capital into single family rentals and build to rent. Just anybody who needs to know what's going on in the for sale market, in the housing market, is really my specialty. And before founding Resi Club, I had worked at places like Bloomberg, where I was a data journalist. And I had been in media for a while, worked at daily newspapers like Dayton Daily News, Cincinnati Enquirer, trade publication like the Chronicle of Higher Education. And at some point when I was working at Bloomberg, I was like, you know what? I'm kind of done with this traditional route of being a reporter, journalist. I was a little disenfranchised with just media in general, and journalism was kind of, I just didn't like how everybody was kind of fit into a box, right? And this is kind of your trajectory. This is what you got to do, blah, blah, blah. And so I decided I wanted to leave and become a data scientist. And I decided, because I'm also not super keen on the higher education system and it's getting a graduate degree and forking out all that money. So I decided I was going to go my own route, which was take a bridge job, leave Bloomberg, and a job that would be more data heavy and would kind of bridge me to become a data scientist. And I would take courses and stuff on the side while I did it. So I go to realtor.com and I worked with their data scientists, their economists, and I would take their data, analyze it, and tell stories, while at the same time doing all of these courses in Python and R and all this data science stuff. And I spent 2 years there. It was 2017 and 18 into 19. And at some point while I was at realtor.com, and I was very deep in the data all the time, and it wasn't just at work, I would also stay after and use their data to run all these different data science tests and all the stuff for my courses. And at some point I was like, you know what? I'm tired of this. I get too deep into my head when I'm only doing data. And I think really where my value is kind of that in between of data and then data storytelling. And that's kind of what I enjoy more. And I don't get as deep in my head if I also kind of sit in that place. And so I left realtor.com. I go to Fortune, and Fortune had hired and recruited me to do a data newsletter for Fortune 1000 executives. And so I launched this thing called Fortune Analytics. And I had started in August 2019. And you fast forward to March 2020, all hell breaks loose, right? COVID-19, lockdowns, all of that stuff. And while I'm at Fortune, I'm paying attention to the housing data at realtor.com that I'd always used in Zillow and all these different places. And I'm just kind of seeing what's unfolding in housing and realizing that the story wasn't quite being told in the way that I would kind of like to tell it, right? And kind of connect the dots. And
Yeah.
so,
You're
in
motivated by the classic somebody's wrong on the internet problem, which I empathize with.
a little bit, and
Yeah.
kind of like adding a little bit here and there. And in 2021, writing a little bit about housing again, and of course, lumber and what was going on there.
Well, even, I want to take a like, quick, just like what was, unless actually, no, let you finish, and then I want to come back
Well,
to the point
so
you said about
lumber,
COVID. Yeah.
the big thing with lumber, everybody's talking about, these huge shortages of lumber. There's not enough lumber being made. Really, what was happening there, in my opinion, is during the pandemic housing boom, because demand is more elastic, right? Demand can go up and it can go down faster, right? And so a lot of what happens in housing is driven by shifts in demand. And during the pandemic housing boom, with the ultra low rates, which makes almost every property cash flow, right? So much was cash flowing, and investors are piling into the market. People are, eager to do that move. There's all this demand for second homes, all the stimulus money. We have, of course, the quantitative easing that plays into all of that, and capital markets just running. So there's so much demand, plus all the work from home, right? Which is not just work from home arbitrage, where you had somebody like me in New York City, takes my income, buys out in Cincinnati, which is exactly what I did very quickly at the start of the pandemic. But it's also even the people who stayed in the places that lost population, the people who stayed, there was like 1 million more household formations, a lot of decoupling roommates. They would see that person normally 2 hours a, a day, and now they're seeing them 16 hours a day because they're working from home, and they're like, I hate your guts, right? So decoupling roommates, all the demand for, bigger homes, right? Because people wanted more space, they wanted that extra office. So an increase in demand from space too. So all the ultra low rates, all the stimulus money, capital markets running, remote work, and the increased demand for space. There's so much demand. Builders were able to sell way more than they could actually build, right? And so at a point early on in the pandemic housing boom, builders tried to ramp up. And that's what all that increased demand for the materials and lumber and all that, and the market equilibrium of supply and demand, the price just soared, right? And that
Yep.
played a big part as the gatekeeper. And pretty much the market was able to say, hey, we cannot increase supply as much as you builders can uh, sell, right? And so
Yep.
I think that's really what drove up lumber. It was just a mad rush. Plus, there's the remodeling side. Everybody's working from home. They're wanting to do the remodel. So in my view, the lumber run was really insanely hot demand for wood, for
Yeah.
frame lumber.
And honestly, like I completely agree. And honestly, even at the time, like I think the broader story around, inflation, what I used to call like the supply chain snagglepuss, like it was all demand driven. Like there wasn't a lot of evidence that it was supply chain issues so much as just like, a huge surge in demand that in fact, like throughput through ports, through shipping was actually higher than it ever been. It's just, that the volume of of demand across the board was just so high because of stimulus money. Yeah, some shifts in consumption too because people are at home but they just had so much money to spend and it was like the analogy is almost like a bar on on SantaCon, right? Like if you have you're expecting your usual lunchtime crowd and all of a sudden you get a crowd of 50, 60 people that are ready to drink. Like blaming it on the bartender that it takes a long time to get a drink is ridiculous. Like it was a huge demand surge. There was supply chain, no supply chain snagglepusses as far as I'm concerned. And I think the data bears that out.
And
Um,
and
yeah,
and and to add on to that, that's how I also view active inventory. And that's how I've covered active inventory for quite a while, which is a lot of what moves active inventory and months of supply is the shifts in demand. And so during the pandemic housing boom, there's all of this demand for housing. Homes are flying off the shelf, and they're flying off the shelf so fast they barely register as inventory. So some of these markets went from median days on market before pending of like 40 days to 3, 5 days, right? They were just flying
yeah,
off the shelf. And so the actual number of homes coming up for sale, the new listings, that was steady. right? It actually increased a bit. And that played a little bit of a role in, the overall increase in existing home sales going up to 6.1 million in 2021. And so, that huge increase in demand really drained down the active inventory. And that's how we got to a place by, March 2022 that we had, 60, 70, 80% less active homes for sale in a lot of markets across the country.
Right. And to your point, like, this is something that I write about all the time, and I think you mostly agree with me, but maybe not entirely. Like, on the housing shortage stuff is like the housing, you actually like have very, very, as nimble as a capital intensive product like housing could be, supply reactions to this huge influx of demand, like building completions, permitting, all of it shot to the moon because, of course, the industry was very responsive to demand rather than any particular shortage. And of course, like prices, you know, followed price, again, prices went up, of course, because that's what they do when you have like demand that's in excess of supply. But it's not like a zoning driven housing shortage that was going on. It was just, again, it was this huge influx of demand driven by really cheap rates. Some changed, living, habits, but then fairly extremely responsive inventory on the supply side. Um, yeah.
Yeah, and I,
It's
I
kind of
think another part of it is that it just came after, a 10-year recovery in housing, right? And so we'd also gotten to a place where we did have, in my view, some type of overcorrection in the housing bust period, where because of the cascading of the foreclosures, the mortgage tightening, all of that, it kind of compounded and it created a deeper bust in the market. And so, I think there are some, you know, I, you know, I, I believe in some of the, narrative of underbuilding of like some of the single family housing during the, 10 to 15 period. Exactly how much, it's kind of hard to put the number on. And then I think there is something to that story of, these robust, superstar cities like the Seattle's, Los Angeles's, Boston's, New York's, DC's of the world. Maybe it is, underbuilding. Maybe it is just those markets have matured to a place where they no longer are trying to seek to fulfill all the demand that they could with supply. So I think there's something to that, but that's kind of an academic type discussion. And the pandemic housing movement itself was really driven by, so much demand occurring at once. Oh, and to connect my thought, I do think though that the fact that all that demand occurred after a 10-year period of vacancy rates falling and active inventory falling, and it occurs then, I think that the market was a little bit more vulnerable to the overheating because it had gotten tighter on the vacancy rates and the actives. Although that itself might not be, entirely driven by that narrative that's out there as well.
Yeah. Yeah. I mean, look, I think to me, again, the bigger part of the story is it's just like supply is fairly responsive to demand. And like that's the big takeaway. Whereas, I think for the sort of housing shortage liberalist narrative, it's just like, that it's just not right. Is that supply is artificially constrained and that forever sort of explains the so-called affordability crisis. And it's just like, yeah, I think I agree. Like supply probably is constrained, certainly maybe in some metro markets, that are already dense, that could be denser. But like the truth is, the clearing price for living in the superstar cities just is what it is. And like people, you can add more supply, but I think you probably get to a point where people will just continue to pay a premium or, over like the superstar cities are always going to be luxury tier, so to speak. And like, you're not going to solve that problem. But like and the same is true. That's sort of the other end, especially on the single family side, is like for people who want single family residencies within commuting distance of those big cities, like people will pay a premium for those things as well. And if you built multifamily there, it wouldn't be the product that people want, right? Which is like I guess that's like sort of a different segue to what the to me like one of the big takeaways or of the last couple of years is just like demand I forget even who put it this way, but like people don't want housing, they want house, right? The demand is for single family homes. More, there's plenty of demand for multifamily, but that was the big driver in new supply, I would think.
Yeah, I think that that makes a lot of sense. And that city argument, it runs into that. How much of it is that San Francisco just doesn't have much more room to build? How much of it is that San Francisco, the incomes and wealth there are astronomical, and there's a lot of like shadow wealth, right? That doesn't necessarily fall into the median. That kind of is in the real world that might not register in the data that could explain some of the bigger upswings in prices. And then how much of it is falls into the building constraints and you know
NIMBYism and all
yeah,
of that stuff.
yeah, and that really kind of falls more into the academic side of it. But in terms of what I focus on, which is the single family market, these places in Texas and Florida and a lot of the Sun Belt markets, they build, right? And so when you have this big run up in, uh, this huge run up in demand, which pushes up prices, and then you have it followed by this period where mortgage rates shoot up from 3, 4, 5, 6 to 7%. What that then did is pretty much the affordability reality from that run up in prices became reality, right? And so in 2022, that reality manifested. And then soon afterwards, these places in Florida and Texas, while they're still seeing people move in, they still have net domestic migration that's positive. It's not like what it was during the pandemic housing boom. And
Right.
so in Florida, it goes from, between summer 21 and summer 22, you have around 300,000 people, Americans, on a net basis moving into Florida. Now, in the most recent 12 months, it was like 67,000, right? So a huge pullback in domestic. And so when you have prices that go up higher, right, than local incomes relative to the other places, because they ran up more in Florida. Florida went up 60, 70% in most markets. And then you also have this pullback in net domestic migration. What it does is it creates a deeper demand shock because it means that the market has to rely more on local incomes, and those local incomes are also more stretched.
Right.
And then
And
you,
that's true everywhere too. I mean, right? I mean, like even now, like people are talking about, okay, record numbers of multifamily supply hitting the, hitting the market at the same time as new shovels in the ground seem to be, dialed back, and everybody's like, okay, at this point it's gonna be bullish anytime now. But the other part of the issue is, of course, like your ability to raise rent is constrained by increases in income, and as income growth really begins to taper off, which I think is kind of the new normal, at least for the foreseeable future. It's like how much could you raise rents anyway? Right? I mean,
yeah, and then the other factor there that I was getting to is with the construction is these Sun Belt markets also have more multifamily supply, they have more single family supply, and the builders, anytime they have product that they got to move, in a way they're always a forced seller when they have to when the market turns, and so they'll do
yeah,
the affordability adjustments to move that product. And what it's done over the past 2 years is builders have continued to maintain sales pace while taking a hit at margin and price to do it. What they've done is they pulled some of the buyers who would have went to the existing and resale market, and they went to new construction. And so then the existing and resale market, those sellers have a harder time selling. That days on market and days before pending rises, and then the active inventory rises, right? And you get more and more slack on the market. And so what you've seen over the past, let's say, 6 months, is that some of that additional slack, right, in the existing market, and that has come back to hit builders again, and those markets have cooled more than they expected. And so some of them are having to
yeah,
go back, do more affordability adjustments. Today, it'll be interesting to see what Lennar says on their earnings report. And Lennar is infamously one of these builders right now that is choosing sales pace, maintaining sales pace over margin and price. I was at an event earlier this month, and Toll Brothers CEO said now they're kind of focused a bit more on maintaining margin in price
Hmm.
versus sales pace. And DR Horton, if you look at their numbers, they haven't done in the past quarter as many of the affordability adjustments and coming down as much on margins as Lennar. And so what happened is Lennar came down more on margin. And so their sales pace was actually -1% year over year or +1% year over year. DR Horton did not come down as much on margin. And so their sales were actually, net new orders were down like 20%. And in some of
Yeah.
these markets, down like 25. Um,
Yeah. And it's also so I want to come back to that in a second, but like I just to repeat it, I think it's such an important distinction that most people don't think about when they think about the housing market is like and I'm not even sure what an analog is to anything else, is like the majority of the market, is still existing, barely is still existing homeowners, right? Like that's the it's the resale market, the used house market, right? Like, the used car market. But for most homeowners, like homes are part asset and part commodity or good. For home builders, like it's all commodity. Like for them, they're not in the asset appreciation business for the most part. They want to move inventory, with margins that their investors will like. So, for them, like, yeah, obviously it's not like they will build in price to market as they need to in order to base, to move volume. Is what you're saying before is like, for the builders, like, okay, existing homeowners, they might say, well, you know what, the market softened. I can't get the price that I remember my house being worth or what I bought it for, 2022 or whatever it is. But like builders are just, they'll be like, no, I'll just build a smaller house. And if I need to kick in some concessions, to take the bite out of the interest rates, like I will. And it shows up in their median sales price and on their margins and the concessions that they offer. So just quickly, sort of specifically, like which markets. So yeah, so okay, so like Sunbelt markets, Florida, maybe parts of Texas, like okay, fine, they've clearly softened. Do you think any of them are going to blow up? Like, or is it just like, yeah, they're
well,
softer?
so the weakest part of the entire housing market is the condominium market coast in the coastal areas of Florida right now. And I was looking through some of the numbers for some of those markets, and some of them are for condos are back to 2006 pricing.
Wow.
And when I saw that in the Zillow data, I was kind of like, you know what? Let me just make sure there's nothing funky going on. So I went to those submarkets, and there were some areas of Naples that I was looking at, and I pulled up a few condos for sale. And the first one that I found a transaction for '06, it's currently listed like 5K under that '06 price. Now, keep in mind, in '06, prices were very high in Florida for the condominium market. They had really ran up. And
Right. Oh
so,
six is right before the financial crisis. Right.
yeah,
Yeah. Okay.
so '06 is another way of saying like 2016 too for the
Yeah.
condominium market in Florida, right? But it was still interesting to see that. And so what happened in Florida is everything that I just gave you in terms of the narrative, right? You had the net domestic migration pullback, right? You had prices go up more in the market. You have the supply of the new construction, right? All of those things. But the other factor for the condominium market is you had the Surfside condo collapse, right, back in 2021. And so the state kind of realized that a lot of these older buildings, they weren't keeping up on their deferred maintenance, right? Because the HOAs, a lot of the people in there are fixed income and they want to fight doing any of these repairs, right? And so the state legislature steps in and said by the end of 2024, they had to set aside, a certain amount of money for the deferred maintenance and all that stuff. And it increased HOAs and it created a lot of special assessments. Some of these special assessments are 100 grand. And so it's caused some people to, list their condos, want to get out. And then also, some of the buyers are just scared of these condominiums.
Yep.
And
But so
parts of
these are
that,
so these are mostly already built, right? These aren't like, things that have been inventory that's been delivered, or is there also a lot of new condo inventory hitting the market now?
I'm excited you asked that question. So Parcel Labs did an analysis and they found that every 10 years that you go back for condos, like when they were built, they're weaker right now. So the ones built like the 2010s are relatively the best, right? Or the current ones, because they don't need as much deferred maintenance, right? So you go back to the aughts, they're the ones seeing bigger price drops than the 2010s. The 90s ones are seeing bigger drops in the odds. And then the 70s and 80s are the ones really just getting their ass beat right now.
Just getting hammered.
Yes,
Right.
exactly. And then the other thing here is, and you have actually been really great on this, which is the home insurance side. And the home insurance side, a lot of that is an echo of what has happened to material costs and happened to home prices, right? And so Florida went up,
And labor costs. Yeah.
yes, all of that, right? And so there's an echo of it because, of course, the replacement costs have gone up. And so because Florida saw a bigger run up in home prices and all of that, that has pushed additional upward pressure on its insurance. And so when you look at these numbers, um, that created an additional affordability shock for Florida. So everybody in the country got hit by home prices running up, right? Everybody got hit by the mortgage rate shock really evenly, but Florida saw prices go up even more, and it saw home insurance go up even more. So it's created an additional affordability squeeze in that market.
But
And
so who is the one, I guess, I'm almost trying to think through like who's the one most exposed and like what are the second order effects? Because it sounds like if you know if you bought your house in the 80s, whatever it is, like you probably own it almost outright. So okay, fine, maybe some household wealth gets destroyed, but that's not the worst thing in the world. I guess like are these, to me like the hierarchy of bad things are like, develop larger developers, building stuff on leverage that now is not going to be able to convert and and somebody's going to default on a big loan. The middle tier would be, maybe home buyers who still have outstanding mortgages who they can't pay off their mortgages maybe so they walk away from them, I guess. That would be the kind of middle thing. But who is the I don't know, or maybe I skipped a step. Maybe there's like
yeah,
lots of
so I
smaller
think
like
that
mom and pop developers. I don't
I
know. Yeah.
think definitely, there could be some of that. I will say that some of the newer development has fared better because some of their, according to what I've been told, and I haven't actually seen data to prove this, but anecdotally, the builders down in that market have told me that the newer stock has lower insurance premiums than the older stock as well. And
Got
so
it.
they fared a little better. I don't know. I can't verify that that's true, but Ali Wolf has also said that over at Zonda, and they're very close with the builder. So I would think there's something to that. But in terms of just overall distress right now, I don't think that's, for housing at the moment, that's not a huge story. We are seeing like a normalization of delinquency rates for housing and mortgage, and we're seeing foreclosures now getting closer back to 2019 levels, and those have been suppressed, right? Those have been suppressed abnormally, so we are going to see that bounce back up. Um, and a part of that is also that, even the places where prices have fallen, you take in Austin and some of these markets, the declines that we've seen so far, there wasn't a ton of buyers that bought at those prices. So Austin, they were ripping. They were up 40% year over year at one point in the pandemic housing boom, and they got up 70% total in 18, 19 months. And so the spring 2022, they're up another 10% in that spring, right? By the end of the year, they had knocked off that 10. So really it was that spring 2022 buyer group. Now, as prices in Austin have continued to fall in 23, 24, and still 25, you are starting to get more of, some of the late 2021s, right, who are kind of, break even. And then if you add in transaction cost, if they were to sell, maybe they're kind of underwater. Still not a huge group. Where it would become an issue is if tomorrow we saw prices cascade another 10 to 15%. Because the reason that would become a problem is that the 23, 24, and 25 vintages and late 22, a lot of them would be underwater, right? And that was a lot of the problem of the housing bust is that when prices kind of started to peak in 2005, we sat up there '06, a lot of '07, right? Although '07, if you want me to get into the markets that were already busting and correcting at that point, I could. But for the most part, those vintages started to really build up, right? And
Hmm.
so at the moment, if you run the numbers, you still don't have that many people underwater, even in the places like Austin. It's not an
Interesting.
eye-popping number at the moment.
So it's really just like normalization off of ridiculous peaks, then rather than some impending doom or crash kind of thing.
Yeah,
Um,
and I think though that what that condo story in Florida probably does allude to, and also the weakness we've seen this year, is that there is some type of downside risk to existing home prices. Because in my view, at least, I don't think that Florida condo prices would have fallen like this in 17 or 18 if these measures were passed. But because these measures were passed after a huge overheating in prices, right, and you already have the builders having to, you know, do all of their smoke and mirrors, right? So, some of the shadow pricing kind of like is already
yep, the
rolled over.
concession. Yep.
There's a greater vulnerability, right? And so I do think there's the greater vulnerability, but in terms of like you know, these fears of, huge, massive numbers of foreclosures, you know, maybe I'm, off, but in terms, my own view, what I see in the data at the moment, I don't think that's uh, the big issue. Now, if you zoom out and you look at the overall distress in the economy, I think where you start to see more concern is, what's happened on the credit card side, right? Especially that bottom 25th of the society that has gotten squeezed more by this interest rate shock, right? Um,
Yep.
so, and then you kind of look at some of the auto numbers, and now student loan delinquencies have, shot back up and normalized after those were suppressed for multi years. So I think on a micro level, there's definitely some households out there that are getting squeezed. And so, maybe that helps to bring in some new supply over time. But at the moment, right now, with the mortgage numbers, they're not too concerning.
What would you look at, I guess? Like, what would be your North Stars if you were like, okay, this if this starts getting worse or better, I don't know, that would be reason for pause. Like, what would be what do you look for?
In terms of what would concern me for downside,
Yeah.
individual downside risk. Um, if active listings were to significantly rise, like right now they are rising, right? And so once they meet this 2019 threshold, if they were continue to run up at 30, 40% year over year, right? That would start to be concerning because that would allude to a bigger drop to existing home prices, right? And as that drop occurred, if you then saw more distress starting to come into the market, that could then create that additional wave of a bigger jump in foreclosures. But that would be the sequence of events, I believe, is that active
Right.
listings would really have to run up, existing prices come down more, and then if distress was also swinging up faster, that would start to be more concerning. But it
Right.
is an interesting moment right now because we're at this kind of place where, you know, we're getting closer to 2019 numbers for a lot of this data. And so it's like once we get there, right?
Do we normalize or does it keep going? Yeah.
Yes. And so that
Yeah.
that's yeah, yeah. So we are
And the other
definitely
thing too is like there has to be an inflection. There has to be some catalyst for, again, it's one thing for home prices to go down, okay, but like, for people for like permanent capital impairment, where you have a foreclosure where equity is lost, like you need either somebody to just fundamentally not be able to afford their mortgage anymore. Say they took out an expensive mortgage and, I don't know, like they just miscalculated their ability to pay for it or some other, or insurance costs get too high and that pushes it over, or they lose their job, I guess. But beyond that, like, home prices can come down without there being, necessarily being a big economic pain to follow, I would think. Yeah.
in my view, the biggest problem for housing at the moment is just that rates were too low in 2021. You know, I don't think there's like this deeper issue of like, the lending and all of that side, like the 2000s. It's that prices, or sorry, that rates stayed so low during that overheating, and that so much of the policy of 21 just increased demand. And so
Yeah.
prices overheated more than they would have. And so when we had rates shock, but really in some ways normalize, right? If you zoom out and you take into account the growth rate of the economy and inflation and all these factors, And so when we got to that point, affordability was so strained. And so the market has just been in this very unhealthy period since 2022. Now, if you look at, the rate of inflation, a lot of these indices, we're going to have real home price declines at least this year for a nationally aggregated basis, where the inflation rate is going to exceed whatever, uh, year over year pricing does this year. But if you look at incomes, at least the numbers that I've looked at, and I think you actually might know more about labor data than I do, but the income data that I've looked at has stayed steady above the home price growth for a bit now. And so there has been a bit of some healing for housing that we've seen. We just haven't seen anything considerable. And so I think the best thing for housing would be a period where, and I think some of my readers, especially the single family rental types, wouldn't like this, but a period where there's very, very little appreciation in the housing market. And then we could have incomes exceed it, and that helped to, heal what happened during that overheating in 2021, where in a calendar year, on a nationally aggregated basis, home prices ran up uh, over 20%, which was actually
Yeah.
right. It exceeded any 1 year period during the overheating of the late 70s.
Yeah, yeah. And I guess the other thing too, there's sort of a few things I want to touch on is like on the demand side, of course, you need, for a real secular driver in demand, of course, is you need more people, right? And a big drive, not, talk about demographics, but like that we do know that population growth is rolling over. And family formation, larger, is less people are less likely to make families and less likely to make big families is another piece of it too. But of course, also immigration was a big driver, and that is probably, I would think, not going to be the case going forward. Has that is that a concern? Has that shown up at all? Is just the fact that a huge demand driver is just of more people, particularly immigration, legal and illegal or otherwise, is that showing up? Are people thinking about that?
So it's a great point, which is if you look at some of this demographic data, the demographics of the country are going to be less supportive for housing than they have been. In terms of the overall population growth, and if you look at just what's happened to birth rates, right? And so I think that is all very true, and I think that could kind of curtail some of these narratives about another overheating for housing, which I'm not worried about another overheating for home prices at the moment. If you look out at the data over the past 60 years or 50 years, there's really only been three real overheatings. It's the late 70s, it's the early 2000s, and then it's what we saw in the madness of late 2020 into spring 2022. And so for there to be another overheating of housing before we've seen a rollover of real prices from the peak and affordability improving, that doesn't make a lot of sense to me, especially when you just look at what's gone on in the market. And so, and I think the other thing that would push back against some of those, arguments of the real bulls for housing is the fact that some of these demographic concerns, right, are going to be less
Yeah.
supportive. And even in the very short window, we saw a very big run up in the number of international migrants. Really, a lot of this is through the southern border in 22, 23, 24, and that has just really rolled over hard. And
Yeah.
even and so that burst of international immigration was, according to John Burns Research and Consulting, at least somewhat supportive for some of this apartment rental supply that's come into the market, this big burst of apartment rental supply. And even if they're not necessarily directly the ones who are, renting out some of this luxury rental supply in Nashville or these places, they're still part of the rental market. And so in some way, somewhere in the rental market, it would have been less tight and softer than it had otherwise been. And so that's gone now. That's rolled over
Yeah.
really hard. It's actually one of the hardest rollovers for any data that I've ever seen, right? The number
And so what is the so what is the data like? In other words, when you say it's rolling over, like what's the metric that's rolling over? Just like new arrivals, or like what is it?
Yeah, so if you look at the number from census for the number of international migrants, right, and you take that number, and then you go and you take a chart of the number of people coming through the southern border, the charts look the same, right? So this huge burst up in international migration to the U.S. was really driven by this huge burst through the southern border. And then if you look at that same southern border data, which leads the census data by 12, 16, 18 months, it shows it's rolled over all the way to almost zero. It's went from
Right.
historic high to way down. So, and I'm no expert in migration data or international migration data, but intuitively, based on what I've seen, it looks like it's going to roll over really hard. And actually, I think I saw some report that just came out that said that like 2025 could be a negative year for international migration. I don't know if that's true. I'd have to check on that.
Yeah, I mean, so but that to me, like that, what you're saying is like that will have to impact prices and right. I mean, if a lot of new supply was built to meet this demand, and then that demand just sort of drops off, I mean, maybe it's possible that builders were anticipating that, but I find it hard to believe that like builders who are building in the Southwest, whether it's that some of them didn't develop a strategy around building inventory for for these people that are now going to be caught head over skis, I would think, right? Or is that not true? I don't know.
Well, so I think the thing to watch there is really the rental market in terms of how that data reacts, right? If we saw a greater weakening there as this starts to occur into 2025, I think that could suggest, there's, a greater impact occurring because of it. But I think so. What I would do for that concern, and I don't know the exact answer of how it would play out, but the two things that I would watch, the number one would be how the rental market data reacts. Number two, specifically watch markets like New York, Los Angeles, and Miami. One thing that's interesting about Miami that not many people know, Miami has been falling for years for net domestic migration. The
Yeah.
number of Americans moving out of Miami exceeds the number moving in. And so
Yep.
even during COVID, when there's all this talk about people moving into Miami, if you look at the data, what occurred on a net basis is just instead of, a huge number of people moving out of Miami that are Americans, it was just a really small number on a net basis. And so what's really driven Miami's population growth in particular is a lot of this international migration. Same is true for LA and New York, where their MSAs have been losing on a net domestic, have been losing Americans on a net domestic migration basis for years. They've been solely dependent on net international migration to hold up their population.
Right.
So I would,
Actually, right. And New York especially, it built a ton, certainly of new multifamily over the last couple of years. Although I just saw some data that said multifamily starts in the Northeast have just dropped off enormously, year over year from 2025 to 2024. So it does seem like people are, or at least builders are aware of, or at least concerned about a potential softness in demand. So it's interesting. So you're basically saying it's less likely to show up in say some of the southwestern markets, right? And more likely to show up in actually some of the legacy coastal markets, which have been more dependent on migration
well,
flows for population growth.
so I mean, it would obviously affect Texas, Arizona, right? But those places also have a lot of other things occurring at the moment too. So I think if you isolate the data for the Miamis, the New Yorks, LAs of the world, I think that could start to help to, see how much just that trend is moving it. But yeah, Arizona, Texas, if they're, they would be impacted to some degree. It's just kind of like seeing it in the data. It might be helpful to zoom in on those markets.
Got it. Okay, switching gears for a second, although not completely. Like it is builder earnings season, right? Sort of becoming sort of upon us, and will be even more so. What's interesting to you? What are you looking for? Like, what are the, I guess, what's interesting? What are you looking for? And is there some, I don't know, is there some like, almost like different approaches amongst the builders that is there some debate that could be potentially resolved in these earnings, like where somebody said, "No, here's the direction to go," in, and somebody else said, "No, we're going to do it differently," and then we're going to see whose strategy worked or no?
Yeah, the biggest thing that I'm watching is the comments on margin and price versus pace. So Lennar has been this one builder who's been very insistent on maintaining sales pace. Even if it means margin and price coming down, and price for them is more net effective. Lennar is really big on the buy downs, right? That's like their big thing that they really lean
Yep.
into. Some of the other builders like KB Homes, their CEO has told me that when they have moments where they need to do affordability adjustments, they'll lean into price more than the buy downs and the other incentives. So they, amongst the builders, they have different strategies on.
Why do you think they do that? Like, what drives the different strategies?
Um, you know, well, like KB Home CEO, his view that he expressed to me is just, they like to be upfront with their buyer, right? It's kind of like the narrative that he put out, and they they you know they think that the buyer values price is their view. And I do know that they have done some of the affordability adjustments on buy downs. If you look at some of the numbers, although they still haven't caught up to Lennar or DR Horton. So maybe they've come around a little bit to buy downs, but back in 2023, their CEO told me they lean into price cuts versus more buy downs. Now, some of the other builders like DR Horton, I pulled a quote from their CEO from April 17th on their earnings call. And the reason he said that they've leaned into more to buy downs is that for a dollar spent on buy downs, it creates a greater decrease in the monthly mortgage payment for the buyer than $1 in price cuts. And I don't exactly know how that works, but it's something that John Burns told Barron's back in 2022, heading into 23, is that there's some arbitrage and something about the yield curve that creates this window where the buy down affordability improvement, a dollar spent there, is greater than an actual price cut in terms of their monthly mortgage payment. Because for the buyer, if the price is X, Y, and Z, even if they're getting the buy downs, technically it's still X, Y, and Z, right? But
Right, right.
their monthly mortgage payment. And then I've gotten some other, feedback that I've heard, which is that some of the builders are able to do these in a way for their like full term buy downs to get it to where they do just enough that these buyers who can't actually aren't eligible due to debt to income ratios are able to then just meet it and get in, which is
Hmm.
a little bit concerning. You have
Right. That would be one that would concern me. It was like, are they doing it in such a way to stretch, like to get people who otherwise wouldn't qualify? But it sounds like they've been pretty disciplined for the most part.
and
Yeah,
getting
that's
them
that's
to
good.
buy
Yeah.
homes that are on paper inflated above the real price, right? So,
Yeah.
they get them with all these buy downs at 350, but really the home was worth like 310, 315. The buyer loses their job, they got to sell it, right? That could create some choppiness. And then in terms of just for the buyer, if we do have a period where rates come down, let's say 100 basis points, 120, 130 basis points, and there's a refi opportunity, well, if they were doing the buy down, depending on what the term of the buy down is, they might not be able to benefit from that. And so I'm not somebody who pushes people necessarily to, have representation and stuff like that. But I do think there could be instances where if you're working with an agent who really knows their new construction stuff, like they're a really smart agent, that might be helpful as you
That's
kind of
interesting.
navigate that.
Are there any, and this is sort of an open-ended question, are there any either sub-markets inventory trends, or I guess even builders who are just doing something a little bit differently that people are sleeping on? I guess like what's not getting enough attention? Either builders a strategy that they're doing, or submarkets that are growing or contracting, or inventory types that are becoming popular or less popular. I don't know. Like what's something that you think people are sleeping on?
Yeah, well, before I answer the question, there is one interesting thing I'd like to add, which is that in terms of the builders, there's not too much that they do that kind of catches us off guard because they move really slow. I was at the symposium that Bank of America put on June 3rd, and Toll Brothers CEO was speaking there, and he said that since he got in the business in the late 80s, early 90s, they essentially built homes the exact same way as then. And there's a lot of reports that if you look at construction in general, let alone just residential construction, it's one of the least innovative sectors in the entire global economy. And I'm not sure everything that goes into that, but some of it could be that there are all these boom bust cycles and so much volatility created from like the monetary setup of the economy that it kind of dissuades investment. That's one argument that I've heard. But then again, if you look at all of the money that went into the prop techs in the space and how many of them just kind of blew up, it's kind of like, well, I don't know about that narrative either, because there has been money
Yeah.
deployed there. To answer your bigger question of like some of the variation out there, uh, Toll Brothers CEO, when he was speaking, he said that their best market right now was their worst markets during COVID. A lot of these northeastern markets, some of the areas around DC, New York, Boston, up into those areas, and those are now their best markets right now.
That's
And
interesting. Yeah, the only place where single family permits increased year over year was in the Northeast. Yeah.
And then,
Yeah.
he said places like Dallas, Atlanta, and I think he might have said Charlotte are doing well for them. Uh, Based on who you talk to and where they're at in those markets, I consider those all choppy markets, right? They saw prices go up a lot. They had a lot of net domestic migration. And so if you go through some of the submarkets there, it can be a very different story. And then he said that Austin, which saw a huge run up during the pandemic housing boom, is still in a period of an adjustment. He said that Phoenix and some of these other markets in Florida and Austin, there's this, uh, I think he essentially alluded to an overhang of spec inventory. I could actually get the exact quote and read it to you because it was an,
In Phoenix, that's interesting.
yeah.
Yeah,
Um,
that's another one of those softer places.
Let me get this exact quote because it was kind of interesting. He said that there's a spec overhang in some Sunbelt metros like Phoenix. It will
And
clean
who is
up.
this? This is Pulte?
This is Toll Brothers CEO. So
Oh, Toll
all
Brothers.
the
Okay.
publicly traded builders, they're at the higher price point. So they're at like this 800, 900, 1 million is kind of like their typical price. He said this spec overhang in Sunbelt markets like Phoenix will clean up over time because the builders are starting less spec homes in the softer markets. And I think that will naturally work its way out. So essentially, the narrative you hear on the multifamily side is what he's
Yeah, that's
saying.
interesting.
Places with
I
the
do think on the innovation part, and this is something that Brad Hargraves talks a little bit about, is like I wonder how much of the constraint is driven by the lenders. Is that lenders like the same. They like to underrate what's been done before, and if you do anything too different, it makes it more challenging. I think it's sort of an underappreciated barrier for innovation in terms of building is just like it is because it's so financed. You need to have it needs to be blessed not only by your lender, but they also have to think down the road. If I ever need to move this debt to somebody else, they need to be okay with it, and an asset sale or whatever it is, and just like that, that overhang on permissions, I suppose, is like somebody's willingness to underwrite an asset that's a little bit outside the box without a lot of track record becomes self-fulfilling because then just nobody wants, there's a hidden premium, premium, I suppose, to doing it differently. Which I
It's
think,
interesting you bring that up because right now, the institutional side of the market, right, they haven't been deploying much in capital into acquisitions of single family rentals, right? When you account for prices and decelerated rent growth and the repair cost that goes into a lot of the scatter site acquisitions because they got to come in and do some repairs, and where the borrowing costs and all of that have gotten to. It's just not very attractive returns on investment and yields right now for institutional capital. And so we've seen that pull way back from the market. And that's been the case since really the second half of 2022. And a lot of these are net sellers. They're not necessarily net selling a huge amount, like Invitation Homes. I pulled their data. And if they maintain their current pace of net selling, they would fully draw down their portfolio in 107 years. So it's not really like a huge sell off, but they've stopped buying and they're kind of culling through their portfolio, right? So
Right. It's clearly a shift in like, in where risk on versus risk off kind of thing. Yeah.
exactly. And so where they are starting, some of them are more interested in deploying capital is this space of lending in particular to smaller builders. So what's driven this huge jump that we've seen over a multi-decade period of bigger builders becoming a bigger and bigger share of the market, going from 10, 15% back when I was a little kid to around 25% by the housing bust time, to 35, 36% in 2019, to now 55, pushing 60% for the publicly traded builders market share. Some of that is access to capital, right? And the balance sheet and all of that. And so there's more capital from the institutional markets deploying into builder financing. The Progress Residential's parent company, the private equity group, they announced earlier this year a fund to create financing for smaller builders. And then Invitation Homes just earlier this month announced something very similar. And so in terms of institutional capital into resi, these next few years, it could look different than what people are kind of used to. And the market is still trying to figure out where yields can be found.
And are these smaller builders, are they doing things niche and different? Like, in other words, because to me, like, I think that's more broadly a very interesting hypothesis is just like, there is an opportunity, where in some ways, like if you want to be innovative, then you have to sort of think through what the bottleneck is. And if the bottleneck is the willingness of capital markets to finance things that are a little out of the box for various reasons, then that's kind of like where the arb is to say, okay, there is innovation that's being left on the table because capital markets won't go there. So if you can figure out a way to do that scalably and repeatedly, there's a lot of money to be made. And I think that's like not only true in real estate, that's true in venture capital, private equity in general, whether it's asset-based finance. Like, I mean, I don't know that necessarily that's correct. That's kind of a thesis that I have, but
I think
yeah.
that's right. Because even if you don't think about it from a process level, right? If you just think about it from a land use level, a lot of them are the ones who are doing these smaller infill projects, right? Going into some of these cities and figuring out how to turn this, available lot, or how to, put in a housing unit there that's clever, interesting, adds value to the neighborhood, will get approval, all of that. That's not where the big builders want to play, right? They do it in a commodity business, right? And the speed of sale and all of that stuff, and kind of sticking to their formula, that's where they make their margin. And so I think,
and building 25 units at a time doesn't do anything for them. They need to be able to build 500, 1,000. Yeah.
exactly. Yep.
Yeah. But the challenge has always been is, okay, well, but building 25 at a time, that can work, but you have to be able to find those opportunities with enough frequency to make the juice worth the squeeze. Because otherwise it's just a lot of wood to chop, is the expression.
And if you're interested in more insights from builders there, I got a few more things from Toll Brothers CEO I can note. One thing that he said that he thinks is going to happen is, so we've been through this period of a lot of the big publics buying up the mid-sized private builders, right? We've been seeing that for years. Toll Brothers CEO, when he was there, he was saying, they've been doing one like every other year for a while. And it's an easier way to break into a market than starting from scratch, right? Well, one thing that he thinks is coming is that more mergers and acquisitions amongst the 20 or so publicly traded giants, which was an interesting thing that he noted, because we haven't seen too much of that. We did see that Japanese company come in, SH Residential, I think is what it goes by, that bought up MDC Holdings, and it owns a bunch of smaller builders that it bought up recently as well. But amongst the really big builders, we haven't seen too many. And Toll Brothers CEO, if I pull up that quote, what he had said, let's get this. Give me a second. He says it's inevitable. More of the major publicly traded builders merging. He said, in terms of bigger M&A, this industry deserves to be more consolidated. There are 10 to 20 public home builders. It hasn't happened yet. There's a lot of cultural differences in these firms, a lot of big personalities at the top. We all have different niches and where we build and how we build and what price range. But I would think it would seem like common sense that over time, there are going to be more and more consolidation of the publics. So I thought that was kind of interesting.
Wonder why, yeah. I don't know. What does he give a rationale, or just like it just makes sense?
Yeah, he didn't get into it too deep, but he wasn't asked the question. He brought it up himself. So that kind of makes me think that he's kind of put a good amount of thought into this. I thought it was an interesting thing for him to say.
Yeah, it is. I have to think about that a little bit more.
And if you want his comments on the NAR settlement stuff, I could give you some of that too.
Yeah, we haven't talked about that at all. Like, to me, I almost feel like that was maybe I'm wrong. I haven't thought too hard about it. Like, and just so the NAR settlement is just like the idea that you can't, the double commission structure, right? Like, in other words, like the NAR, they had a sort of agreement amongst themselves that for any transaction, basically you need to have both buyers and sellers represented by agents. Is that like kind of like a fair?
Well, and it was trying to dislodge the commissions actually being stated in the MLS and kind of the industry going along with the norms, and so the argument there is that was made in these antitrust lawsuits is that NAR and real estate, the transaction side, was essentially a monopoly that was or a cartel is what they were, said in an op-ed, that was preventing, pricing negotiation on these commissions. Now, the commissions have been negotiable for a long time, but once this came in, the process of, so like they were taken out of the MLS, and the theory would be that, buyers would be able to negotiate more on these and that the commissions would come down. But as of today, we really haven't seen it, right? It's pretty much been pretty close to a nothing burger in terms of real impact on housing and transaction cost. And so what Toll Brothers CEO was saying is that they haven't seen significant downward pressure on broker commissions, at least not yet. He does think that they'll drift down a bit over time potentially. He says what they are going to do there is they don't want to be the mover in the market. So if somebody else goes to a flat fee, let's say it's a 10 grand flat fee for the commission, they will then follow suit once the market has gone there. But they don't want to test the market. But what they really want is they want to go to flat fee. That's what Toll wants.
Yeah.
Which it makes a lot of sense because a lot of their homes are, $800,000, $900,000, $1 million. And so logically, I could see why they would want to go there.
They wouldn't want a percentage based, yeah. And on the consumer side, it's like, look, if you want to use a rep on the buyer, then all the power to you. You still can, and if you don't, it seems fair that you should be able to just sort of sell property. If you find a house on Zillow and you do the work and go visit it, like, why would you have to pay a buyer, a commission for an agent that you never met, or like a double commission or anything like that?
Now, one thing that's interesting to me is it kind of brings up this other concept that I have, and I think about a lot for housing, which is housing has always a very high switching cost. And that's one of the reasons that among goods in the economy, it's one of the things that sees the lowest amount of turnover, right? People stay in their homes a long time. It used to be around 7, 8 years. Now it's like, 11, 12, 13, and some of these markets 17. And so some of those switching costs are, of course, psychological, right? Where, let's say, if I moved right now, my daughter, who's 8, she would have to leave her school district, right?
Yeah.
And I would have an unhappy daughter and an unhappy wife who would be kind of mad
Yeah.
about that move. And there's also other switching costs like the transaction cost. And the seller in the US is who pays typically that transaction cost. So that's another one. Some of these other ones can be over time. Like, let's say if you live out in California and your property tax, because of what it's Prop 13, right? That's the prop, correct?
I
And
think
so
so. Yeah. For yeah.
their
For
property tax kind of, is fairly sticky, becomes a smaller percentage of your discretionary spending, and all of those things that kind of go into, you know, these switching costs that are always at play in housing.
yeah. Yeah, and it's like right. In some ways, you want because you want people invested in place. That's some of the like the positive externalities is that people come invested somewhere, and you don't want them moving around too much. But of course, on the other hand, you like dynamism, and so there's always a bit of a tension in terms of whether it's a good or a bad thing that people are staying in one place for longer. I think it depends on what you're measuring, I guess. Um, one last thought, and just and before we go, like if I mean, you look at this data a lot, and like all the agencies, they're pretty good at putting out free data, and there's also like you mentioned Parcel and Zonda, and like there's a lot of interesting data sets. Is there a blind spot? Like if you could wave a magic wand and say, I wish I could see this data, like is there something like that?
Oh boy, as much
Doesn't
data
have to be just one. Yeah.
as much data that exists in housing. And there's a tremendous amount. I would still love to see more. One thing that I would love more is less of like me having more data, and it's more like the consumer who is making these decisions, which this is such a big expense for them. I would love for them to have as much good data and information as possible. So one thing that I'm not as big of a fan on are like some of these states where the sales are not public record, right? That final sale in the non-disclosure states. I watch these listing sites very closely, and sometimes they take off information of some of these listings that I think could, I would like consumers to know, like when was the
Oh,
last,
interesting.
if this home was listed 12 months ago and it was on the market for 90 days or 180 days and had so many price cuts, and then it was taken off and 6 months later was listed again, I would like the buyer to know that bit of information, right? And so I think, my thing is less of like, hey, I would love me to have access to X, Y, Z data. And it's more of like, I would just love for consumers to have the right data in front of them that they can make the best decisions. And so I do think, though, that what Zillow has done in these online listing sites, I think we've gotten to a lot better place than we were 25 years ago, right? There's a lot
Yeah.
more information moving around. People have access to more stuff. People know how, and especially states like where I live, to go into their auditor site, find out, former sales and what homes sold for in the past. And so there is more of a flow of information, but I would love that to just continue to accelerate.
That's interesting. It's funny that you mentioned Zillow. I just very quickly, and you could say like you don't follow these too closely, but like, and I certainly don't. But like on the Zillow, CoStar, Redfin, like there's a bit of a rivalry that's been going on there, and part of it is just like is building these different businesses around lead acquisition, rental, like the agency fees, but also like the lending businesses around them, like Rocket Mortgage acquiring. Like, do you? I was gonna sort of like ask you generally what you think about all of that in terms of who the winners or losers, or I don't know, but is that something you think about? You follow that closely? I'm not doing a good job just even describing the landscape because I
Yeah,
don't.
so I think my thing that I'm seeing there is they want to bite off more pieces of the pie, right?
Right.
So some of these mortgage companies, right, they want to have access to the consumer, right? Like Zillow already has. And then Zillow, which has the attention of the consumer, they want to have in-house mortgage, and they want their agents preferably that buy leads for them to also bring that buyer then to their mortgage company, right? And so we're seeing a lot more attempts to kind of be more full circle and to be a bigger piece. And pie is really not the right word for it, but more of the steps of how, and that's not even a really good. Uh, so Rocket Mortgage, they bought Redfin recently, right? And so what
Yeah.
that does is it gets them access to the consumer at the beginning of the journey, right? Then they have Rocket Mortgage in the middle, and then Mr. Cooper they went out and bought, and that's a servicer. And one of the things that Mr. Cooper has a lot of access to is all these people who have existing mortgages, right? And at some point, they're going to need to, if rates were to come down, some of them are going to refi, right? Or maybe some
Right.
people do cash out refis and all of that stuff. And so that can kind
Right.
of
They want to own the entire value chain, origination, refinancing, servicing. They don't want to give any of it away. Right.
you had a much better
Yeah.
way of framing it. And so that's
Yeah.
kind of what we're seeing. And Zillow's approached it its way. And then CoStar, a lot of their fight has kind of been to establish themselves on the search side with homes.com. They already have apartments.com. But if you just follow their CEO and see, his track record, you can see that he has a lot of ambitions pushing
Yeah.
into the core residential space. Whereas, for a long time, CoStar has been more on the commercial side.
And it's interesting because like I think this is something that you flagged, but maybe it was Mike Del Prete. I don't remember exactly, but that Zillow's origination business, which I don't even know they had an origination business, has been slowly but steadily gaining share. Like they are, like in some ways, like Rocket Mortgage acted defensively. Rocket Mortgage is a non-bank mortgage lender. Obviously, it's been super successful. But maybe they saw Zillow saying, "Hey, we've got all these. We're still the number one top of funnel place where people go to look for leads. Like we should be in this. We should be in the origination business too." And it sounds like they've been doing it and executing on it pretty well. And maybe that's why Rocket Mortgage got a little nervous. I don't know.
Yeah, and I think you hit the nail on the head. I think that's a part of it. I think they were kind of seeing what Zillow was doing and kind of realizing they had an opportunity. And if you look at what they would have paid to buy Redfin a couple of years ago, it would have been at a much higher price.
Yeah.
Redfin had a lot of trouble, right? And
Yeah.
so that valuation has really come down. And so I think, and I don't have evidence of this, I wouldn't be surprised if Redfin's been trying to find a buyer for a bit.
Yeah.
Their situation they were in, and Rocket kind of saw the opportunity, seized it. Of course, on the mortgage side, there's choppiness there as well, and so Rocket Mortgage might have just seen this as kind of like the competition of where Zillow is going, the fact that they've had so much success with their core businesses, and the opportunity of the price point they could get these companies at might have made it appealing for them.
Yeah, yeah, no, 1,000%. It's like it's always given the general down market for new originations. The fact that Zillow is growing this business has always impressed me, even if it's sort of like small scale off a small denominator effect. But yeah, it's sort of interesting. Anyway, okay. Any this is awesome. I guess any concluding thoughts? Anything like I don't know, like anything that you burning thing that you want to get off your chest, or not so burning?
I think we've kind of covered well, what have you not gotten to touch on that you would like to in terms of housing? Because you have a lot of great takes on housing and a lot of other macro and economic things. And especially, I really liked your insurance take because I think the narrative there was kind of really diverting from what kind of the reality
It's
was.
climate change. Yeah, exactly. Yeah.
Yeah,
Um,
yeah, I do think there's something to the fact that we've had a higher concentration of building occurring in the disaster prone areas, right? So like that,
yes, and more valuable building too.
yeah,
Yeah,
exactly.
right. Right. That was like the right. In other words, like, sure, if you build, it's not necessarily, and again, this isn't like a meant to be a debate at all on anthropogenic climate change, anything like that. It's just more like the narrative of kind of like, well, it's just got to be climate change. And it's like, no, like if capital costs go up, labor costs go up, goods costs go up, and you put more and more expensive stuff in places where there is more likely to be natural disasters, then of course you're going to have big claims. Whether it's solar farms in Texas, where hail used to just hit the ground in the desert, now it hits solar farms. Like, okay,
And the other thing that was
yeah,
fun about it is if people just took any time to look at what was happening to auto insurance, it was the exact same thing. Because
exact same
car
phenomenon. Yeah,
prices had overheated and the labor and all of that, and it literally was just
yeah.
tripling over. I think insurance just is downstream and it lags behind.
Yeah, exactly. It's got that tail whip effect where it's, they'll be, and because they also like, they talk about, people like to talk about NIMBYism, and there is a real NIMBY problem with insurance, because like insurance is so heavily regulated, and insurance company and sort of regulators like to get the insurers at both ends. They like, want them to cover as much as possible without increasing prices at all. So but when they do have to respond to a cost shock, it often takes a lot of time. Finally they have to prove to the or they either exit the market completely, or they finally say, look, we're losing money here, and then they raise prices, and then you begin to see their profitability, and the costs then go up to the consumer well after the other inflation metrics already hit, kind of thing. So it's a little bit of
And
a bullwhip
that's
effect.
a great
Yeah.
point, which is that also not all of the overheating is played out into insurance yet in some of these states that have really fought it. And so
Yeah.
more is still to come in some of those areas.
Yeah, it definitely could be. No, I think we covered everything. Like, I was sort of interested around, what the sort of softness isn't necessarily disaster, which I think we talked about. And also I think the impact of migration and sort of where markets would hit, I think is also something sort of interesting to me. And then, what you were thinking about is builders report and what they're thinking about, what's top of mind for them. I think that was kind of, and then the data stuff. I mean, those are the things I was most interested in. And of course, we could talk about publishing and independent publishing and all that all day, but I think maybe that's for another time.
Yeah.
You know,
And so
yeah,
really appreciate you having me on. Housing, housing, housing. I would definitely recommend my audience to follow you. And if anybody wants to read along with my content, ResiClubAnalytics.com, just put in your email. And you can also find me on Twitter at NewsLambert.
yeah. Thank you, Lance. And also like it goes without saying, yeah, Resi Club is great. It's got great data, really. And I just think, in terms of it's like sell side quality, I think coverage of the builder market, but just delivered in a way that I think is much more digestible. And yeah, I don't know, can't speak highly enough. All right, thank you, Lance. All right, I'm gonna end it.